Welcome to the deep dive. We're here to cut through the noise, get straight to the insights that really matter. And today, we're diving headfirst into something huge, something that has fundamentally reshaped global geopolitics. A moment in June 2025 that really made the world, wake up to a new reality. We're talking about the direct military conflict between Israel and Iran, and crucially, its profound, immediate impact on global oil markets. We're focusing specifically on that critical choke point, the Strait of Hormuz. Our mission here in this deep dive, it's to distill the absolute must-know insights from a whole stack of comprehensive reports on this conflict. We want to help you understand the acute risks, the ripple effects, especially if you're in an energy importing nation. These are already hitting hard. Okay, let's unpack this. So for years, we've talked about this shadow war, right, between Israel and Iran, sort of simmering tension, always bubbling just under the surface. But on June 13th, 2025, well, that shadow just disappeared instantly. Israel launched what they called Operation Rising Lion, a multi-day assault. And look, this wasn't just some limited airstrike. No, this was a comprehensive campaign. We're talking Israeli warplanes, drones, hitting the very core of Iran's nuclear and military infrastructure across numerous provinces, including those really sensitive facilities at Natanz and Isfahan. And maybe most importantly, they executed a significant decapitation strike, taking out top-tier Iranian military and scientific leaders. We're talking IRGC Commander Hossein Salami, head of the Revolutionary Guard Corps, also Iranian Armed Forces Chief of Staff Major General Mohammad Bagheri, and prominent nuclear scientists, too. Israeli Prime Minister Benjamin Netanyahu, his stated aim was clear: roll back the Iranian threat. So this feels like an undeniable fundamental shift, doesn't it?
Well, absolutely. What's fascinating here is precisely that, the shift itself. For so long, you had the covert ops, the proxy attacks, and these allowed markets to sort of compartmentalize the regional tensions. They could say, okay, this is contained. It's not a direct state-on-state fight. But that ambiguity, that sense of a contained conflict, it's just completely vanished overnight. The overt, undeniable nature of these hostilities forces markets, forces everyone, really, to confront what used to seem like remote worst-case scenarios. Now they look highly plausible. The whole playbook has changed.
And Iran's response was just as direct, just as swift. No ambiguity there either. They launched hundreds of missiles and drones directly at Israeli territory, targeting major urban centers, Tel Aviv, Bat Yam. And despite Israel's pretty sophisticated air defense system, the multi-layered one, some Iranian missiles did get through. They hit buildings. The human cost was immediate and tragic. Iranian officials reported over 200 killed, thousands injured in Iran, while Israeli authorities reported dozens of civilians killed, nearly 600 injured. Amnesty International, naturally, immediately called for civilian protection on both sides, a truly tragic human cost. And as these initial blows were exchanged, the world's attention, it just snapped almost instantly to one tiny yet utterly critical spot on the map, the Strait of Hormuz. This narrow waterway, it's barely 33 kilometers wide at its narrowest point. It's the only sea passage connecting the Persian Gulf with the Arabian Sea. Think of it like the world's most vital energy artery. Seriously, just how vital? Well, according to the U.S. Energy Information Administration, the EIA and the IAEA, the International Energy Agency, it's the transit route for a staggering 20 to 25% of the world's total daily oil supply.
20 to 25%. That's huge.
Huge. And about 1/5 to 1/4 of global liquefied natural gas, LNG, exports too. It's absolutely critical for exporters like Saudi Arabia, the UAE, Kuwait, Qatar, Iraq, and Iran itself, actually. So following the Israeli attacks, Iranian officials immediately renewed those long-standing threats. We could close this critical choke point. And the IEA didn't mince words. They warned such a move would have a major impact on global oil and gas markets. So with all that as background, well, it's no surprise the market's reaction was immediate and sharp. Brent crude futures, that's the international benchmark, had been trading quite comfortably below $70 a barrel in early June. Then came the conflict. Prices surged dramatically. We saw jumps over 4% on June 16th and another 4.4% on June 18th. That pushed Brent into the mid to high $70 per barrel range almost overnight.
Right. And if we connect this to the bigger picture, this volatility, it stands in stark contrast to the market sentiment just weeks before. Before this whole thing erupted, the prevailing outlook was actually, quite bearish, surprisingly so. Prices were trending lower. Major investment banks, Goldman Sachs, Barclays, JPMorgan, they were all forecasting Brent to average somewhere in the mid-$6 for the rest of 2025. So this sudden spike into the mid-$70 is not about physical supply and demand fundamentals suddenly changing. Not at all. It is almost entirely a function of a newly injected and very severe geopolitical risk premium. It's the market starting to price in all those what ifs. What if Hormuz closes? What if supply gets hit?
That's fascinating. So this price surge isn't just market psychology playing out. It's reflecting something far more tangible and frankly chilling. the very real physical dangers now gripping the Strait of Hormuz itself. This waterway, I mean, it's a super highway for the world's largest tankers. Closing it would effectively sever a vital global energy artery, and we're already seeing the security environment just degrade rapidly. The combined maritime forces, that multinational naval partnership, they've moved on to a war footing in the region. Commercial ships are being told, look, avoid Iranian territorial waters, stick closer to Oman. And as if that wasn't enough, reports are documenting a surge in electronic interference, specifically AIS jamming, that's the automatic identification system ships use to see each other, near Iranian ports. This dramatically increases the risk of collisions, misdirection. It creates operational danger even without a formal blockade being announced.
Exactly. And the intense market anxiety we're seeing, it exists in this strange paradox with the underlying physical market fundamentals. It's quite something. Because prior to the conflict, the market actually appeared pretty comfortable, supply-wise. You look at the IEA's June 2025 oil market report. It came out just as the crisis began. It painted a picture of a well-supplied market for the rest of the year. Global oil supply was projected to grow significantly, actually outpacing demand growth. And critically, the OPEC Plus alliance, OPEC Plus Russia and others, held an effective spare production capacity of over 5 million barrels per day. That's a lot, mostly sitting in Saudi Arabia and the UAE. Global oil demand growth looked modest. Inventories have been building steadily. It all looked okay on paper. However, and this is a crucial point, this situation exposes a critical flaw in the market's traditional safety net. A very large portion of that spare capacity, those barrels from Saudi Arabia, the UAE, Kuwait, Iraq, they also had to transit the Strait of Hormuz to reach global markets.
So the buffer is trapped behind the potential blockage.
Precisely. It means a blockade wouldn't just cut off existing supply streams. It would also trap a huge chunk of the world's emergency buffer right there in the Gulf. That makes the whole global supply system far more brittle, far more vulnerable than during, say, a typical supply outage in just one country. It's a real double whammy.
That's a truly chilling thought. So if a big part of our safety net is essentially trapped, what other options does the global market really have to buffer such a shock, and what does this all mean for oil prices going forward? Analysts are already modeling this, right? Two main scenarios seem to be emerging. Scenario A, they're calling it contained conflict. This assumes, okay, hostilities continue, but there's no full, sustained Hormuz blockade. Here, the main impact is this persistent geopolitical risk premium baked into the price. Goldman Sachs, for instance, suggests a risk premium of, say, an additional $10 per barrel seems justified. That pushes Brent towards the $85, $90 range. And they also say if there's a targeted Iranian disruption, maybe Iran's own exports get hit, taking 1.75 million barrels per day off the market prices could still hit $90. Okay, then there's scenario B. The escalation and blockade scenario, this is the catastrophic worst case. Iran actually attempts a full or partial closure of the strait through naval action, maybe mining the waterway, attacking shipping directly. That would effectively halt something like 20 million barrels per day of oil flow. 20 million.
An almost unimaginable number.
Right. And the investment banks, their projections here are dramatic. JPMorgan warns Brent could surge to $120, maybe even $130 per barrel. Goldman Sachs projects prices above $100. Barclays, ING, they also see prices well beyond $100 a barrel. It's a range, sure, but the direction is unmistakably sharply upwards.
Yeah, and just to put those numbers in perspective, remember where the banks thought prices would be before this? Around $63 to $66 per barrel. So now Goldman Sachs sees scenario A, the contained one, around $90. Scenario B, over $100. JPMorgan jumps from about $66 pre-conflict to a really striking $120 to $130 in scenario B. Barclays goes from $66 to maybe $85 in scenario A and around $100 in scenario B. What this clearly highlights is a dangerously asymmetric risk profile. It's skewed heavily to the upside. I mean, the potential for a $50, $60, even $80 per barrel spike in a severe scenario that far outweighs any potential for price collapse. OPEC Plus would almost certainly step in to prevent a total crash. So for you listening, especially if you're in an oil importing nation, hedging against an upside shock, that's now the critical strategic priority. This really isn't a time to be complacent about where prices could go.
And beyond the direct energy impact, these kinds of oil price shocks, they trigger powerful economic shockwaves, don't they? They fuel inflation, complicate monetary policy all over the world. Let's look at the U.S. and the EU. A sharp rise in oil prices presents a huge policy challenge. In the U.S., gasoline prices are already ticking up. Analysts expect near-term increases, maybe 10 to 25 cents a gallon pretty quickly. And this really complicates things for the Federal Reserve, right? They're trying to engineer the soft landing for the economy. As of their June 2025 meeting, the Fed was holding rates steady, but signaling maybe cuts later in the year. An oil-driven inflation spike. That creates a classic stagflationary dilemma. Do you raise rates to fight the new inflation, risking recession? Or do you cut rates to support growth, risking inflation getting entrenched? Tough choice.
Very tough. And the numbers are worrying.
Mm.
Oxford Economics estimates every $10 increase in oil adds about half a percentage point to CPI, the Consumer Price Index. And JPMorgan calculated that if oil hits $120 a barrel, U.S. CPI could jump to 5%. That undoes a lot of progress.
Wow, and the EU faces a similar problem. The European Central Bank had actually started easing, cutting rates. A new oil shock would just reverse those disinflationary trends they were finally seeing. We know the EU is actively coordinating with the US on potential measures like releasing strategic oil reserves. Okay, let's drill down now into the Republic of Turkey. It's a really compelling case study for an energy importing nation caught in this. Turkey is exceptionally exposed. It imports nearly 2/3 of its primary energy. 2/3. The Turkish Central Bank has pointed this out for years. It's a major structural weakness. And the impact at the pump, it's been swift and severe. Mid-June price hikes pushed gasoline, benzene, and diesel motorin above that psychologically key 50 Turkish lira per liter mark in major cities like Istanbul. We're talking gasoline jumping 3 lira in just 1 week, diesel up by 5 lira. You, as a consumer there, are really feeling the squeeze, seeing daily price changes linked directly to that surging Brent price.
Absolutely. And this surge has profound macroeconomic consequences for Turkey. It's not just about the pump price. First, inflation. These fuel hikes are a direct, powerful inflationary force. And this is happening in an economy already battling, over 35% annual inflation as of May 2025? This directly jeopardizes the government's whole disinflation program. That program was kind of banking on oil prices staying well below where they are now, probably below $65. Second, the current account deficit. As a major energy importer, higher oil prices automatically worsen Turkey's deficit. That goal they had, narrowing it to below 1.5% of GDP, that looks likely unattainable now. And third, social pressures. While we haven't seen massive protests yet, the strain on consumers already facing a high cost of living is immense. It's palpable. And opposition figures are, naturally, using these price hikes to criticize the government's economic management. That creates potential for social discontent down the line. This raises an important question. How does Turkey break out of what risks becoming a truly vicious economic cycle? Think about it. Higher oil import bill leads to a worse current account deficit. It puts downward pressure on the Turkish lira. A weaker lira then makes dollar-denominated oil imports even more expensive in local currency, which feeds back into higher inflation, requiring further fuel price increases at the pump. It just spirals. And this forces the central bank into that really difficult choice you mentioned. Hike interest rates and stifle growth, or let the currency depreciate and unleash even more inflation. It's a very, very tight spot.
That sounds like a brutal economic trap. So what can actually be done globally and for nations like Turkey to mitigate this? We know global levers exist, but their effectiveness in this specific crisis, it seems limited, doesn't it? Take alternative routes to bypass Hormuz. There are pipelines, like Saudi Arabia's East-West pipeline, the Petroline, and one in Abu Dhabi. But their combined capacity is only about 2.6 million barrels per day.
Which sounds like a lot,
But it's a tiny fraction of the 20 million barrels per day at risk if Hormuz closes. It barely scratches the surface. And other pipelines, like the old Iraq-Turkey line, are either in disrepair or just inactive. Not really an option right now. Then you have the Strategic Petroleum Reserves, the SPRs. IEA countries hold over 1.2 billion barrels collectively. The U.S. SPR alone hold over 400 million barrels as of mid-June. Now, the U.S. SPR can release oil pretty fast, over 4 million barrels a day maximum rate, but there's a lead time, about 13 days to get it flowing. So while SPRs are powerful tools for calming market panic, maybe smoothing out initial shocks.
they buy time.
Exactly, they buy time. Even a full coordinated global release wouldn't be enough to cover a sustained Hormuz closure. It's a temporary fix hoping for a diplomatic or military resolution.
Right. And the international diplomatic response is, well, it's complex, to say the least. You have the U.S. and EU condemning the violence, calling for de-escalation, while also scrambling to manage the economic fallout. The EU is actively coordinating with the U.S. on stabilizing energy prices, as you mentioned. But the strong political alignment between the U.S. and Israel, that complicates America's ability to be seen as a truly neutral mediator here.
Yeah.
And then there's OPEC plus worldwide. They hold that nearly 5.4 million barrels per day of spare capacity. Theoretically, that's the most significant physical buffer the market has. In a moderate disruption scenario, they could potentially fill a supply gap. But their willingness, their ability to act, that depends heavily on internal OPEC plus politics, external pressures. It's not guaranteed. And we're already seeing public disagreement between the IEA and OPEC over whether SPR releases are even needed yet. That highlights potential friction right there. It's a very delicate dance.
It certainly is. So, bringing it back to the listener and thinking of Turkey as that powerful case study for vulnerable nations, what are the actionable recommendations? What actually needs to happen, both right now and for the longer term? Okay, short term, the next 0 to 3 months. Crisis management mode, number one. Secure alternative cargoes. Absolutely imperative. Governments need to direct their state energy companies, go find crude oil, find LNG from non-Hormuz sources, West Africa, North Sea, the Americas. Replace those critical supplies like the 20% of Turkey's crude that comes from Basra through Hormuz. Number two, intensify strategic diplomacy. Use every channel. US, EU, Gulf producers advocate for de-escalation, yes, but also make sure your specific energy security needs are on the table in any international response, like an SPR release. And number three, implement targeted social buffers, temporary fiscally constrained support for low-income households, critical sectors like agriculture, public transport. But communicate clearly, this is a crisis measure, not a permanent entitlement. Okay, that's the immediate crisis. What about the medium term? Say the next 6 to 24 months. Building real resilience. First, accelerate the expansion of strategic storage for crude oil, for petroleum products. Existing capacities in many countries are just inadequate for prolonged crises like this could become. Invest public and private money here. Second, diversify energy import routes and sources. Pursue long-term supply deals, maybe with Eastern Mediterranean producers. Reevaluate, maybe rehabilitate those bypass pipelines like the Iraq-Turkey one. Don't rely so heavily on one route. And third, perhaps most fundamentally, launch an aggressive demand-side management program.
Yeah, this is key.
Right. A national energy conservation campaign. Incentivize public transport. Accelerate vehicle electrification if possible. Improve industrial energy efficiency. These are the structural changes that build genuine, lasting resilience against future shocks.
Look, the global oil market is really at a critical juncture right now. It's caught between these bearish fundamentals we saw just weeks ago, a well-supplied market on paper, and this catastrophic tail risk of a full-scale war centered on the Strait of Hormuz. The eruption of direct military conflict between Israel and Iran has injected a geopolitical risk premium that has, frankly, just overridden traditional market analysis for now. And the world's primary safety nets, that OPEC plus spare capacity, those alternative pipelines, they are fundamentally compromised by the nature of the specific threat because they are largely located within the potential crisis zone itself, or they simply don't have the capacity to handle the sheer volume of oil that flows through Hormuz.
So, for you listening, particularly in energy importing nations, this global crisis isn't just headlines. It poses an existential threat to economic stability. The imperative seems crystal clear. We need to move beyond just short-term crisis management. We need to build durable, long-term resilience against these kinds of external energy shocks, shocks that are fundamentally beyond any single nation's direct control. And as you think about all this, maybe leave you with a few final thoughts to mull over. Can concerted international diplomacy, maybe involving big players like the US, maybe even China, given they're Iran's primary oil customer, can it truly contain this escalation before the world faces a full-scale blockade of the Strait of Hormuz? Is the market truly rationally pricing this extreme risk right now? Or is there a dangerous complacency creeping in? Are we underestimating the potential for a sudden, sharp escalation that could send prices into triple digits literally overnight? And maybe looking beyond the immediate crisis, what fundamental structural reforms can nations undertake in energy policy in their broader economies to permanently reduce their vulnerability to future geopolitical oil shocks like this one? And how can this current crisis maybe be leveraged as a catalyst? A catalyst for building a more resilient, a more diversified, and ultimately a more efficient national energy system for the long haul. Lots to think about there.